Hi, welcome to Tobias Financial Advisors third quarter 2023 market update. We are here to provide insight and education as to what's going on in the markets and the economy as we move towards year-end 2023 and on to 2024. Before we get started into the presentation, just some high-level reminders that this information is general in nature, and if you have specific questions about your financial situation or your portfolio, please reach out to us at Tobias Financial Advisors, and we'll be happy to review how this information reflects in your goals and your portfolio. Some other housekeeping: in your webinar toolbox here, there should be a way to put questions in. If you have any questions that come up during our presentation, please put them into the chat box. We'll do our best to address questions at the end of the presentation, and if not, we will certainly try to get back to you. As well, the slides should be available under the handouts section of the webinar, and we're happy to share those with you, and you could download those to look at our charts and see if you have any more questions for us as we move through our presentation today. So just a little bit about who we are. We are Tobias Financial Advisors. We were founded in 1980. We are a comprehensive wealth management organization that helps clients really kind of decipher what's going on in the financial world, but how it really relates to them personally, how it relates to them to achieve their goals. We manage over $675 million of assets for about 300 families. Amongst our entire team, we have about over 75 years of cumulative experience. And one of the things that we really pride ourselves in is that all of our registered investment advisors are certified financial planners. That means that we really take our craft seriously, and that we are able to look at different facets of the financial picture, whether that be tax, with our accountants on board. We have exit planning for business owners that may be selling their business or transitioning their business in certain ways. And we also have two chartered financial analysts who are on the call today. Chad Neesmith, our portfolio analyst, is with us today. Chad, please introduce yourself.
Hi, hello everyone. Thanks for the time today. My name is Chad Neesmith. I'm the portfolio analyst at Tobias Financial Advisors. I do trading and research for the firm, and I'm a chartered financial analyst, as Matt said, and a certified financial planner. I thought, Matt, you were going to forget about the CFAs on board that we had, the investment side, when you were introducing everybody earlier, but we got it. But overall, I'm really happy to be here today and happy to talk about the economy, interest rates, and investing. On a personal side, I do have a 6-month-old at home, and he is just a bundle of joy. And overall, I like it here in South Florida, and I like it here at Tobias.
Yes, Chad's had his coffee today, so he's ready to go to talk about the economy.
There's never too much coffee.
My name is Matt Sainholtz. I am president and senior wealth manager here at Tobias Financial Advisors. Started with the firm about 18 years ago, and we are excited to see where we're at today and use my experience to help clients kind of navigate some of the ups and downs, not only the markets, but also with different tax regimes and tax perspectives, and helping people ultimately achieve their goals and live the lives that they want. As we're here in the October, I'm thrilled the Dolphins are on their way to having a winning record. So we'll forecast out that for 2024 as well, I guess, maybe later on, Chad.
Yeah.
So what do we do here at Tobias Financial Advisors? Before we dive into what's happening in the markets, why do we do this in the first place? Our goal is to develop a customized portfolio for you to help you and your family achieve your goals. That means understanding what it is that we're really investing for, whether that be retirement, college planning, long vacation, taking a half a year off of work, whatever it might be for your particular circumstance. We are trying to build a portfolio that's diversified broadly, that's invested efficiently and creatively to reduce expenses, reduce your taxes, and ultimately grow your money in your nest egg so that it helps you achieve your goals. Today's agenda. We will be reviewing what's been happening in the markets year to date in the last quarter specifically. We'll also be talking about some different interesting data points that we're seeing happening, some trends we're seeing in the markets. Chad will be doing a great economic update, talking about interest rates with where we're at today and some of the mortgage rates we're seeing and some of the interest rates that we're seeing. And then, yeah, we'll even touch on the president election. It's less than just over a year from now. We'll be going to the polls. And so we'll kind of look at that from a market perspective and what that may mean in the year ahead. So third quarter returns, 6 red arrows down. Not what we'd want to see, but from a year-to-date perspective, most stock markets are still positive, even given this pullback in the last quarter. Bonds are down as well this past quarter, which really is a function of interest rates and what the Fed is doing with the interest rates. Chad, that'll be a main point of our discussion later on in the presentation. So we'll be diving into that. But when you look at some of, let's just pick on international markets here in this column, you know, the dispersion or the variability between the best quarter and the worst quarter, we've seen some great quarters in the 25% area, and in COVID times, we've seen performance down in the negative 20% area. So, you know, it's not great to see stocks down 3 or 4% at a given quarter, but it's definitely not unheard of. And given that we are positive on the year, you know, it's kind of natural. Maybe there's a little bit of a pullback as we head into year end. We'll dive into a little bit more about what is driving the markets, but just on the surface, the third quarter stocks and bonds were down. Both of our kind of a main high-level asset classes have performed in a negative fashion in the third quarter. But as I noted, year to date, this chart, there's more green than red. On the left-hand side, there's a bunch of different specific subclasses or asset classes that you could invest in, different countries, different types of bonds, different types of stocks. What's leading the charge in the U.S.? The first two are up 27 and almost 25% are large tech companies here in the United States. Think about Apple, Facebook, NVIDIA. Some of these technology stocks have really, after coming off a pretty negative year of 2022, have really rallied strong, and there's some themes of artificial intelligence and some other drivers in those sectors that are really driving the economy. But on the flip side of that, you know, we look at different types of companies. The growth companies are more technology names that I mentioned. But the other side of the coin, in the US at least, there's the value companies, and values are traditional sectors like energy and banking. If you kind of picking out this Russell 1000 value through September, that has only returned just over 1%. And so when we blend it all together, the S&P 500, which is a measurement of kind of the US stock market, it's up 13% year to date, which is higher than kind of the long-term average return of around 10%. So it's a pretty good year domestically. And anything that sticks out on the chart from you on year-to-date returns, Chad?
Yeah, I mean, there's a couple of things. You know, obviously at the very top is NASDAQ. You have those big 7 companies that are driving returns. And then you have gold that's up about 3% this year. You know, a lot of people bought gold 2 or 3 years ago as an inflation hedge. We got a lot of inflation. But even over the last 3 years, gold is flat, and it hasn't performed as people would have hoped. So it hasn't performed like an inflation hedge. Another thing to think about is China. China is going through its own specific country-specific issues as a declining working class population. You know, the one-child policy is really coming around and starting to kind of bite them a little bit. And a lot of citizens over there are still not spending from COVID. They're still scared from all the intense lockdowns, and they're going into a real estate, like a credit crisis almost, that we're closely monitoring, but that's down 7%. Those are the 2 main things that stick out to me when I look at this.
Excellent. And one more comment on this is bonds. It's going to be kind of our theme of today. I think we're going to talk a lot of focus on interest rates and bonds. A measure of the U.S. bond market is down 1% this year, and that's a function of higher interest rates. And if it does end up negative for the year, that'll be the first time ever that the bond market has been down 3 straight years in a row. So we haven't seen that before, and we'll dive into why that's happening and what that means for your portfolio. But all in all, so far, a positive year for a balanced type of portfolio that we recommend. As far as volatility, this is kind of an interesting data statistic that we came across. So let me try to explain what you're looking at here. On the left-hand side is how many times the U.S. stock market, as measured by the S&P 500, was either up 2% or down 2% in a single day. So far this year, we've only had 2 days that is either higher than 2% or less than 2%. That is very a lot lower than compared to last year, when it was over 46 days that were more volatile. And back in 2020, the main COVID year, the first year of COVID, is also very volatile. That tends to show us that the market has had a much smoother ride this year. And when you look at the volatility kind of is a measure of also of uncertainty. The markets like certainty. We kind of like to have a fresh outlook on what's going to happen in the economy or in the markets. So in really volatile years, since 2001, when there's been 10 or more days that are plus or minus 2%, the stock market's really flat. Uncertainty, ups and downs. It doesn't lead to a lot of people investing into the market. It tends to lead to people pulling out of the market or selling some of their positions. Contrast that with when it's less volatile, a little more certainty. Those years when it's less than 10 days that had plus or minus 2% in volatile trading days, the average return since 2001 was over 17%. As we just noted, the U.S. is up 13%. So this statistic's still holding, relatively true as we head into the year end. Less volatile, positive returns. It might not always feel that way when you're listening to the markets and you're seeing what's going on in the world, but all in all, 2023 has been a positive year thus far. And we always talk about long-term performance, so we're looking back at 1 year, 5 year, 10-year periods on this chart, and it's all green. And what that attributes that to is kind of long-term investing. A couple of different things I'd like to point out here over the 1 year. So since last September 30th, that was kind of the market low, and this recent downturn, September 2022. So since 1 year, we've actually rallied back pretty strongly. And in particular, international stocks have done better than the U.S. stock market over the last 12 months. We are big believers in diversifying globally, and we think that that trend may continue as we move forward in the next few years. When looking at the 10-year returns, you can see the U.S. stock market is up about averaging 11% over the last 10 years, whereas international and emerging market stocks, that emerging market is usually typically like India, Brazil, China, some of more of the growth countries that represent emerging market stocks. That's only up 2% over the last 10 year annualized, and global real estate's at 3%. So the U.S. has been really outpacing some of the other asset classes we looked at over the last 10 years. And sometimes there's something just called reversion to the mean, or just kind of how things equalize. And we think that international and emerging market stocks over the next 10 years should be a good place to be. So that's just kind of an interesting approach to the long term. As we move forward here, I'm going to pass the comments over to Chad. He'll focus on the economic update for 2023.
All right, thanks so much, Matt. I really appreciate it. We get to talk about the economy. I like talking about the economy. On the left side of your screen, we see real GDP. This is going back to 2001. As you can see, we had a bumpy road along the way with the great financial crisis in 2008, and also COVID is the sharp down, sharp up on the way. But overall, you can see there's a 2% trend in real GDP growth, and we are tracking along pretty well. This is as of the second quarter of 2023. But the third quarter GDP is running a lot better than, as you can see, 2.4% year over year. So the last reading in the second quarter is 2.4%. But as of right now, we're looking at over 5% real GDP growth for the third quarter of 2023, which is a big surprise because we did not expect this even in the summer. Many experts expected flat GDP in the third quarter just a few months ago, and we're just getting really strong data, including today we had retail sales come out better than expected. Consumers are really driving this growth. And on the right side of your screen, you can see the components of GDP and what our economy is made of. The very top, about 4% is housing, 14% is about investments, ex-housing, 20% is about government, I guess 17%. And then 70%, almost 68% is consumption. That's consumer spending. That's what we're seeing in the data, is that consumers are still spending. They still have savings that we did not foresee, and they're able to just kind of brush off these higher prices as they spend going out to eat. They're spending on cars, personal care, car insurance, all kinds of places that they're spending the economy. And we thought that we would see a slowdown in spending, but it just hasn't happened. And so that's driving higher interest rates, which is affecting the bond market. It's all a circular thing. But overall, the economy is looking really good. GDP is looking really strong, and it's really brushed off those recession scares that we had this time last year when most of the market was expecting a recession. We just didn't get it. A lot of times people are always fearful about things that could happen, things that could go wrong, but they don't factor in, we've had really surprising data that's good, and they don't think that they discount the upside. And that's what we've experienced so far in the last few months and actually just this year, is just the consumers have spent. And, with all of the geopolitical things that are going on, they're still just spending in the face of higher prices, and they've locked in. A lot of consumers have locked in low mortgages, and they're using that excess savings and that excess money to spend on other things, and that's what we're seeing. Let's move on to the next slide. We'll talk about inflation. So, consumers are spending, and that's feeding inflation. But as we saw last summer, that 9.1% in May, this is on the left side of your screen, driven a lot. About 3% of that was gas prices, energy in the green bar. It's slowly come down, a few ticks every month, and now we're finally down to 3.7. But what I think the main story is, we see the headline number of 9.1 and 3.7, but what is that inflation made of? So last summer it was made of higher gas prices, higher used vehicles, some housing, but not as much. And it's really, that inflationary prices, inflationary pressure of energy, cars, airlines have really kind of made their way out of the inflation data. And now it's more in shelter and travel and restaurants. Restaurants spending is up about 9% year over year. Shelter inflation is taking up about half of the inflation that we're seeing so far. I think shelter is up about 7% this year, and it's about a third of the consumer price index. And so when we think about what's driving this shelter inflation, for one, rents haven't caught up to the cost of purchasing a home. So as you may know, home prices are up a lot and mortgage rates are up a lot. It's really expensive to buy a home right now. Some people are still deciding to buy a home, but a lot of people are choosing to rent. And those rents, because you don't have the choice to buy, or it's harder to buy, it's causing more demand for rentals right now. And we're going to see that as an ongoing story in inflation. And it's something that's going to take a long time to kind of work its way out of the economy. So the path from 9% inflation to 4% is going to be a lot quicker than we're going to see from 4% down to 2%, which is the Fed's target rate. And that's part of the reason, that's probably the biggest reason that we're seeing interest rates on the longer end, the 10-year, really increase, and the market is expecting higher interest rates for longer. It's because they're thinking this inflation is going to take longer to work itself out of the economy than previously expected. And on the right side of your screen, we're just talking about core services, which is another big part of inflation that people are focused on. We're seeing a lot of inflation in transportation services right now. A lot of that's actually car repairs and car insurance. Those are the two main drivers there. I know that my insurance rates are going up a lot, especially living in Florida. It's hard to get a cheap car insurance policy nowadays, but and also there's homeowners insurance in Florida that we're also worried about. But overall, airline fares are finally starting to ease on the economy, and we're seeing just the core services being kind of like stubbornly around 3 or 4%, and something we're expected is just like a 4% inflation rate, between 3 and 4 for an extended period of time. We're going to move on to the next slide. We're talking about employment. So overall, we've gotten really promising and really good employment data this year. The economy is still adding jobs. Just in September, we added 336,000 jobs, which was a nice uptick. A lot of those jobs are actually part-time work. but jobs are jobs and jobs are good. And you may be thinking about or seeing the headline unemployment rate and seeing it tick up from 3.4% to 3.8% and thinking, oh man, the job market's really, because the unemployment rate's going up, the job market may be fading a little bit. And that's kind of not really the case, because on the right side of your screen, you see participation rates. And what we're seeing in the 25 to 34 or 54 age group is that these people are coming out and looking for jobs. And that's causing the unemployment rate to increase. And overall, it's still a strong employment picture that we're seeing. But overall, that's really strong it just feeds into GDP, it feeds into interest rates, and it feeds it helps tell the whole story, really. This slide serves as a really good reminder of, even though we're looking at the economy and we do pay attention to it and we do like to monitor it as far as investing goes, it becomes almost impossible to time these things and time your investing and your philosophy. So going back to 1950, it compares how the S&P 500 has performed in relation to industrial production. So even if you could possibly time a recession from the actual economic data, it's really hard to profit on the investment side. So the market normally peaks 7 months before the recession, so way before you would even get some of the data that a recession is starting. And the market recovers generally before the recession ends. So you'd have to be right on early, both going down and on the way back up, to actually do better than just staying invested. And a big part of our philosophy is to just maintain a nice balanced portfolio. And on average, the market's going to go up after so many years, and just enjoy that fruit of your labors, basically, and just staying invested in the market, and not try to time this and not try to jump in and out of the market when it comes to the economy.
Yeah, absolutely, Chad. We've been hearing talks about recession for the past going on almost 2 years now. We've been talking about when's that recession going to come, when that recession is going to come. And if you listen to the headlines at the beginning of the year, you'd be missing out on a positive year return at this point in time. So I echo and fully support what you're saying there. It's very, very hard to time it up just right, to get it right. So it's really just about maintaining the balanced approach as moving forward.
That's right. Now we're going to talk about interest rates. So the economy has fed into our interest rate story, which affects all investment classes. What we're seeing right now is the federal funds rate. So whenever you hear about the Federal Reserve increasing interest rates, they're talking about this specific interest rate right here, which has gone from 0%, as you can see, in between 2019 and 2021, up to 5.38% that we're at right now. And it's gone up at a record speed as the Fed started increasing interest rates at 3/4 of a point, every month. It felt like, and I was like, man, this is crazy. And now they're still increasing, just at a slower rate. But we're at 5.3%, which is above the rate of inflation that we're seeing. So overall, we're in what's called restrictive territory, meaning that interest rates are supposed to be slowing the economy a little bit, even though we haven't seen it in consumer spending yet. But overall, we think that we're pretty close, or in the ballpark of peak interest rates, what's called interest rates that they're going to be the highest for this economic cycle. And we think that rates, while they could stay higher for longer than we expected, aren't expected to increase that much more from this current level. So I'm going to just draw some attention towards the two dotted lines, which is the blue line, which is the Fed's year-end estimate of where they think the Fed funds rate is going to be, and the green is where the market is actually pricing in where these interest rates are going to end up. And what we have seen over the last several years is these two dotted lines have pretty much been on top of each other. But lately, we've seen a divergence in long-term interest rate, or the longer run number. As you can see, the 3.95 at the far right of your screen in the green versus the 2.9% that the Fed had originally forecasted. And that is just going from some of this positive economic data that we're seeing, and in this inflation data that we're seeing, that the market is also thinking that it's going to be hard for interest rates to go under 4% for a little while.
Yeah, I think, Chad, just to bring it to kind of homeowners and mortgage rates and things that affect people's day-to-day lives, the mortgage rates of 2021 of being so low, a 3% 30-year mortgage, I think those days they're not forecasted to come back, and we don't think they're coming back.
Yeah.
So we have to plan accordingly, and that's why we say interest rates probably stay higher longer. However, we do, as the Fed and the market anticipates, the interest rates may stay the same, higher for longer, or start to over the next couple of years start to trend down, but
Yeah.
not all the way back to where we were a few years ago when rates were just at almost zero, or were at zero, historically low rates.
Mm-hmm. Yeah, mortgage rates are definitely high right now. I'm sure we're going to see some over 8% mortgage rates coming around very soon. What's interesting is, we have a lot of people that are still buying homes into these rates, thinking that they're going to refinance at a lower rate. And as we get the data, it's more and more unlikely that they're going to be refinancing anytime soon, at least for the rate that they thought that they would get. The date the rate. I don't know if you've heard about that, Matt. It was you buy the house and then date the rate, where you plan to refinance down the road. We'll just monitor that and see what kind of trouble they could possibly get into. But we don't know. Anyways, we'll talk about just bonds and how interest rates affect bonds. On the left side of your screen, we have U.S. Treasuries on the top left, the 2-year, the 5-year, 10-year, and the 30-year. As of right now, they're yielding almost all of them right around 5%. As of this morning, the 10-year is actually at 4.8 because we had that positive retail sales data this morning. It's moved up that interest rate. But as rates have moved up, as you can see on 12/31, the 10-year Treasury was yielding just under 4%. Now it's just under 5%. It's caused the price and the total return of the 10-year Treasury to be negative. So, and especially the 30-year, which is down double digits right now, 10.5%. If you were to go out and buy a 30-year Treasury just at the beginning of this year at 4%, that move to 4.48 is you've lost 11% almost, well, 10.5% in your portfolio. And so those are the risks that we're weighing when we're looking at fixed income, is the possibility of rising interest rates, how long they'll stay, where we think the direction is going to go. And, because we think that we're nearing, the age of, or the area of just peak rates, and we think that rates are either going to stay or go lower over time, we're actually adding to some of the 10-year Treasuries in our portfolio. And we're making those trades as we speak, basically. And I just want to talk a little bit on the right side of your screen. There's impact of the rise and fall, the 1% rise and fall of interest rates. And as you get earlier in the year, we were weighted more towards the 2-year Treasury and the 5-year Treasury. As you can see, those tighter returns, if interest rates were to rise 1%, you'd still earn like 3% on your money, but you'd be capped on the upside. You'd be capped at earning about 7% right now if interest rates were to fall 1%. And we don't think that increasing interest rate is much of a risk as much as it was earlier in the year. So we think that the trade-off between the 10-year Treasury and the 2-year Treasury is actually pretty good. So, we really want to give ourselves a chance to get that double-digit upside on bonds. It's possible in environments, as we'll see on the next slide. But overall, we do like adding. We like adding to that longer duration in our fixed income portfolio because it diversifies our models, and it diversifies our portfolios a lot because bonds tend to have lower correlation and negative correlation to equities over the long term. And so we like that. And if it's paying us 5% to take a little bit of risk off the table, that's what we're going to do. This chart is a really powerful chart. Matt and I had been talking about this one before the webinar. And because we think we're at peak interest rates, this is just historically looking back at periods of time where interest rates were at peak rates and what happened in asset classes over the next 12 months. And so CD rates are the gray bar. The aggregate bond index, which is the dark blue, the Bloomberg US aggregate bond index is the dark blue, and high yield is also bonds, but a little bit lower credit quality in bonds. And then the green is the S&P 500. So a lot of investors may be thinking, hey, my portfolio hasn't done particularly well over the last couple of years. I haven't gotten the return I thought. 2022 was extremely volatile. I'm getting paid 5%. I would just take all my money, buy a 5% CD, and let's just look at this next year, or look at this in a couple of years when things look different. And they're looking at historical returns versus forward returns, which is what kind of their I guess the fallacy is that they are not considering that you could possibly make double digits in bonds. You could possibly make double digits in stocks. And these returns while we don't want to go 100% into any one of these asset classes, we do like exposure to a lot of different asset classes, and all of these asset classes could perform very well. But it's not always the case, as you see in 2000, when the S&P 500 was down 11% after a peak interest rate. That was part of the dot-com bust. And it's, we can't really predict how stocks are going to do in a given year, but overall, if you look historically, there's been a benefit to diversifying in asset classes.
Yeah, there's been this chart, this story is, I think, one of the most important themes that we're presenting here in our webinar and going forward into 2024 with rates. We do get that a lot. Why don't we just buy a bunch of CDs or a bunch of treasuries and then wait it out and see what happens? Well, we're investing for the long term. The CDs and treasuries could maybe be a 1 or 2 year time frame, but 1% drop in interest rates on a 10-year bond, you could be up in the 12, 13, 14% area. And we want to have that opportunity. It's about being diversified, having some assets in the portfolio that'll move differently than just cash. And so that's what we're seeing out there, and that's what we're adjusting some of our bonds to move from that 1 or 2 time frame to maybe more around the 5-year time frame, 5 to 10 year time frame. So this is just really important. It's just a reminder of not wanting to, still putting all your eggs in one basket if you put it in cash. And that is something that, that's what we don't advocate for. And this is just really powerful to see different time periods and different return structures when we're close to or at peak CD or interest rates. Mm-hmm. As we move forward, as we move ahead, we're going to just touch high level on the 2024 coming presidential election. This is just the returns from 1928 back to the 20s on all these different elections and what happens during the return during the actual year of the election versus the year subsequent to the election. On average, the election year has been better and higher than the long-term average, which the long-term average is usually about 10%. And so that election year, although there was going to be a lot of headlines and we get a lot of news stories that can tend to make us want to react emotionally with our investments, or, oh, what happens if this party or this person gets in, and what if this happens, what if that happens? Well, we have to just look at averages and long-term results, trying to, I would say, guess, and we're just trying to forecast the market as to what is going to happen when one person gets in versus the other person. And it's really not necessarily the person. It's more about what's happening in the economy, what's happening in the markets during that presidency than it is the actual person in office. Our next slide does a nice graphical representation of what the United States has experienced over about the last 100 years on different parties and being in power. So it's not necessarily, well, this party's in, the economy and markets are going to do worse, and vice versa. We tend not to position our portfolios based upon the politics of the day. What we're looking at is more the economic data, what's going on in valuations, and what the market's telling us as far as how companies are priced. This is right here just a reflection of capitalism, and that we use the stock market, a company uses the stock market to generate capital to invest in big projects that they couldn't invest in themselves. And as investors, when the markets and the economies are strong, that tends to result in higher asset prices, higher stock prices for us, bigger dividends, and that's what we're investing in. We're not investing in politics or someone's social platform. We are investing in companies that have to operate whether the laws change or the politics change. And over the long term, we want to remind our investors that you might not ever always agree with who's in charge, but it's also equally important not to necessarily over-relax in the portfolio as to who's in charge as far as the politics goes. So we're getting close to wrapping up. We want to get to kind of some of our outlooks and some potential optimistic approaches for the following year and what we're seeing today. Chad, what's one of the top things that you like about, why are you optimistic?
I'm optimistic because we think that we're getting close to peak interest rates, meaning historically it's a good time to be an investor. You're able to lend money out and get paid for it. You're able to get paid on cash. You're able to get paid on all kinds of asset classes right now. So historically, this is a really good time to be an investor, whether or not you predict a recession to be in the next however long, in the next year, 6 months, however long. The labor market is continuing to be strong. The economy is still adding jobs. There's still 9 million jobs available for people to go get. And as we saw earlier in the participation rates, that people are going and getting those jobs and they're looking for them. We've gotten some early quarterly earnings reports, mostly been from banks. Those have been really positive. Corporate earnings have been great so far, as you know, they're benefiting from inflation, effectively able to sell at a higher price. So as a long-term inflation hedge, stocks are a really good choice. And those early earnings reports, a lot of it, has been banks, and they've been making money off of checking deposits. So if you have a lot of money in a checking account, they're paying you 0.5% on it. That's not what the market's paying right now. You can go and get a money market, or we can look at yield options for you in your portfolio. But overall, earnings are strong, and they're looking to be continue to be strong. And then stock market valuations, you know, the market was down last year a lot. Valuations have come in. We haven't seen the earnings depression that we thought that we would have seen. So it just has made valuations look good, and stocks look a little bit cheaper than they have been over the last couple of years. Particularly international stocks have been cheap, and they're about 30% discount to domestic stocks. So we think that it's a really good portion of your portfolio to be invested internationally and also in emerging markets. So overall, they remain attractive. Now we got the not so good news. As you may know, the geopolitical risk, there's been wars in Ukraine and just started in Israel very recently. That may put pressure on the economy. It's something we don't expect to have a very significant effect on our GDP, but however, you know, it could spread. Things could get worse. It's something we're keeping a close eye on. Domestically, the U.S. House is having some trouble appointing a speaker. They should be having a vote pretty soon. They may have elected a speaker since we've started this webinar, but overall, not having a leadership in one part of Congress is not very good from a political perspective or a fiscal spending perspective for our economy. But overall, it's something we're going to monitor closely. And then some consumers are starting to feel pinched a little bit. Student loan debt repayments have started. They started in October. And as we spoke earlier, the higher mortgage rates are making it really difficult to buy a house. And also, if you're looking to buy a car, you need to borrow at a higher rate. Credit cards are at higher rates. So a lot of consumers are getting hit by having debt payments and having higher interest rates. But they're still spending right now, but we don't know how long they can keep spending at the rate that they are. But it's something that we're paying attention to.
That that might show up in the data in the next few months because, student loans haven't been being repaid for over 3 years now. And so that could be a drag on the economy as well. So how are we positioning our portfolios?
As we talked earlier, in fixed income on the left, we're extending duration, meaning that we're buying the 10-year treasuries versus the 5-year treasuries and the 2-year treasuries to lock in these higher yields that we're seeing in this area of the fixed income market. We're keeping the bonds high quality, so we're not buying junky bonds. We're buying treasuries. We're buying very secure debt. We like the safety of that, and we don't think that we're getting paid enough to take the risk on the lower end of the credit markets. For stocks, we're still maintaining our international exposure. We do think that they're good valuations at the 30% discount that I talked about. They're paying a higher dividend yield than domestic stocks, and the diversification benefits are very strong with international exposure. And quality companies are still attractive. You know, we think that we want to have quality companies in our portfolios, and we want to invest for the long term and not just buy. You know, we're not flippers, so we're not buying a junky company trying to just sell it for a quick markup or a quick buck. You know, we like long-term investing. On our tactical sleeve in the opportunistic section, we do have preferred stock for increased yield. We're getting about 6.5% on that right now. We do like we do like how preferred stock works, and we do like it in the portfolios as a diversifier. But also in that section, we are exploring a move into risk assets should we get the opportunity. Right now, we do have a section of that portfolio in floating rate treasuries and a nice safety net, but should we get a good price, we're going to make an aggressive move and go for it.
Yeah, so these are just different buckets of a well-balanced portfolio that we're highlighting here right now. We are coming up to our end of our presentation today. Unfortunately, we don't have a lot of time right now to address any questions that came in, but we certainly will follow up with you. And if you are not a current client of Tobias Financial Advisors, please give us a call. We're happy to discuss what you've heard today and what we are thinking about the economy and the markets going forward and how that relates to your financial goals. And if you are currently a client, thank you for your support. And we will be definitely in touch as we head into year end and we go into 2024 and address some of these themes that we spoke about today. Thank you for joining us. Chad, thank you.
Thanks so much.
Presentation.
Yeah, you too, Matt. Thanks a lot.
Thank you, everybody, and we will be in touch soon. Thanks for joining us today. Take care.
Bye.